Hello, good afternoon, everyone, and welcome to the Strategy and Stock Picks Q1 2026. In today's session is on the China-Hong Kong's market, and you may take a look at the agenda stated in the slides later. Also, do not forget that we have a special giveaway this round. You just need to scan the QR code on your bottom right corner on our screen to follow our TikTok account, then read the instruction on post captions to win home a Sony noise-cancelling headphones. Also, a gentle reminder for you to submit your questions in the Q&A section. You may also upvote other participants' questions. Questions with the highest number of votes will be selected by our speaker. And for those who are attending from YouTube Live, you may also join in on Zoom with us from the link we pinned in the comment section. We still have a bit of time before the webinar begins, so sit back, relax, and our speaker will begin shortly. For those of you who just joined, please be reminded that if you have any questions during the session, you may submit your questions in the Q&A section, and our speaker will tend to it after the session ends. Also, do not forget that we have a special giveaway this round, so you just need to scan the QR code on the right bottom corner that you are seeing on our screen right now to win away a Sony noise-cancelling headphones. Okay, without further ado, let's start the webinar. For this session, we have Mr. Louis Wong, Director of Phillip Securities Hong Kong, to cover the Hong Kong market outlook. Mr. Louis, you may take over.
Okay, thanks. Good afternoon, everyone. First of all, may I wish every one of you a very happy and successful new year. Okay. Today I'll cover China and Hong Kong market, the strategy and stock picks for first quarter 2026. Okay. So the Hong Kong market fared quite well last year, with the Hang Seng Index rising 27.8% in 2025, outperforming the US and Japan. Okay, and the Hang Seng Tech Index was up 23.5% in 2025. These are the top gainers among Hang Seng Index constituent stocks. So for your reference, what are the stocks, the companies that did well last year among the blue chip, Hong Kong blue chips? You can see the first one is China Hongqiao, 中国 Hongqiao, 1378, which is an aluminum manufacturer, up more than 200%. Followed by Zijin Mining, 2899, up
My
160.
apologies to interfere, Mr. Louis. We are
Yeah,
not seeing the slides that you are sharing.
sorry. Okay, can you see my screen now? Share screen now?
Yes, we can see it now. Thank you.
Okay. Okay, I'll go back first because just now. Okay, Hang Seng Index was up. Let me close this one. Okay, Hang Seng Index was up 27.8% in 2025. Hang Seng Tech Index up 23.5% in 2025. These are the top 10 gainers among Hong Kong blue chip companies. China Hongqiao ranked number 1, rising by more than 200% last year, followed by Zijin, and then SMIC, Hansoh Pharmaceutical, PopMart, Innovent Biologics, stock code 1801, Chow Tai Fook, Sino Biopharmaceutical, and JD Health, China Life Insurance. I think you may be familiar with some of the names. So there are 4 main themes. By showing the top 10 gainers, we also sort out 4 main underlying themes that support the strengths of these gainers. Okay, the first one is cyclical resources, represented by China Hongqiao and Zijin Mining, benefiting from global inflation and industrial demand, as well as the safe haven demand because of geopolitical tensions that drives gold and silver prices, as well as even copper prices higher. Okay, the second main theme is hardcore technology, represented by SMIC, serving as the core carrier for domestic substitution for imported chips, namely NVIDIA chips, and also to enhance technological self-reliance in China. Okay, third underlying theme is innovative drugs, represented by Hansoh and Innovent, with the market focusing on source innovation and international pricing in biopharmaceuticals. Increasingly, we notice more and more international multinational companies are joining force with Chinese biopharmaceutical company to jointly develop and commercialize some innovative drugs that are researched and developed by Chinese biopharmaceutical companies. Okay, the fourth theme is specific segment consumption, or the so-called new consumption stocks, 新消费, represented by PopMart, Chow Tai Fook, and JD Health, demonstrating that even in a weak recovery environment, consumption in specific sectors still possesses strong vitality. Okay, entering 2026, I think among these 4 themes, we are still upbeat on the 3 of them, excluding specific segment consumption, which we are less upbeat because of weakening consumer confidence in China, as well as the high valuation achieved last year following the drastic rally in share price. PopMart now, the valuation not cheap. Lao Pu Gold also likewise. But we still like cyclical resources because of amid all these geopolitical tensions, I think, and also the decentralization of US dollar and more central banks increasing their gold reserves. I think gold still has more upside in 2026 that will benefit gold mining companies. Okay, hardcore technology. I think the domestic substitution is the trend that will continue. That China will try to reduce the reliance on NVIDIA and foreign chips, especially AI chips. Okay, now let's take a review of the China economy. China reached its headline growth target last year, but the recovery remained unbalanced. It's an unbalanced recovery. The economy relied heavily on external demand and state-led high-tech investment, while the internal engine, domestic consumption, and private investment remain hampered by low confidence and the property overhang. So I think this will provide you the backdrop of your investment strategy or stock pick strategy this year, because it's an unbalanced recovery. So we would suggest investors to focus on sectors that do well, that outperform the broad economy, and avoid those sectors that the laggers or the sectors that are still suffering or under pressure. Okay, GDP growth, the economy expanded by 5.3% in the first half of 2025, slowing to 4.8% in the third quarter. So cumulative growth for the first 9 months stood at approximately 5.2%, still above the 5% official target set by the central government. Industrial production remained a major pillar of strength, particularly in high-tech sectors. In the first 11 months last year, high-tech manufacturing value-added output increased by 9.2%. Retail sales growth was tepid, expanding by only 3% year-on-year in September and 4% overall for the first 11 months. You can notice that the growth rate is even below the overall GDP growth rate, signaling cautious household spending and also rising unemployment, especially among the younger generation. Investment, fixed asset investment was a primary drag, contracting by 2.6% over the first 11 months, heavily weighed down by a 15.9% plunge in real estate development investment. So we reckon that property development, Chinese property developers are still not bets pick this year because the inventory. Now China has unsold property in the amount of more than 700 million square meters. So every year the take-up is about 40 to 50 million square meter. So it will take at least 8 to 10 years to digest the inventory of unsold property. Okay, and this leads to a property crisis which is still persisting. The real estate sector entered its fourth year of decline. While some tier 1 cities saw primary market stabilization, lower tier cities continue to face high inventory and falling prices. Export dominance. Exports defied expectations despite the US tariff. It grew roughly 5.9% in the first 11 months last year, and China successfully pivoted to emerging markets like ASEAN. ASEAN now has become the largest trading partner, China's largest trading partner, and also to Africa to offset declines in shipments to the US. New quality productive forces, 新质生产力, massive investment in strategic industries such as AI infrastructure, semiconductors, and new energy vehicles help sustain industrial growth even as traditional sectors struggle. Later, I will go into more detail about the new trio and new trio in China. New trio in Chinese is 新三样. And now, since new trio seems to be out already, people are talking about new trio, new 新三样, which may be the investment, one of the major investment themes going forward. 新三样, new trio. Targeted stimulus. Rather than floodlight stimulus, authorities use targeted measures like consumer goods trade-in programs, which significantly boosted sales of home appliances and communication equipment in the first half of the year. Okay, so the economic outlook for China in 2026 is characterized by a great transition toward high-quality, tech-driven growth amid persistent structural headwinds. We have to admit that the Chinese economy is still facing quite many headwinds, especially structural headwinds, but there is a chance for the economy to, for the country to transform itself, to make a transition toward high-quality, tech-driven growth. While the manufacturing and export sectors are expected to remain resilient, domestic challenges like the property slump and weak consumer demand are expected to temper the overall growth rate. Okay. Outlook GDP growth is expected to moderate to around, we expect, this is our house forecast. We expect China GDP growth rate to moderate to around 4.5% this year, compared to 4.2% to 4.5% projected by the IMF, and 4 to 4.4% projected by the World Bank and OECD. Okay. 2026 marks the first year of the 15th five-year plan. China, they have this five-year plan. So entering 2026, it will be the 15th five-year plan. Usually at the start of a new five-year plan, there used to be more policy initiatives. The government will be more aggressive, taking policy initiatives to lay down a good foundation for the next 5 years. Okay, so we believe the 15th five-year plan will prioritize technological self-reliance and new quality productive forces, 新质生产力, over traditional real estate-led growth. High-tech manufacturing investment is shifting toward semiconductors, AI renewables, and advanced materials. AI is expected to start providing meaningful productivity gains by 2026. So that will also shape the investment themes for this year and beyond. Okay, high-tech manufacturing. Remember this sector: semiconductors, AI, renewables, and advanced materials. Okay. Despite global trade tensions, China's ability to produce high-quality goods at competitive prices remains a core strength. That's why China can still pivot to ASEAN and Africa because of the competitiveness of its exports. Though net export contributions may decline as global demand softens. Okay, authorities are expected to maintain an accommodative stance with potential interest rate cuts, but we don't expect big cuts. We expect 10 to 20 basis points and expanded fiscal stimulus to help the economy reach its growth target. This is the outlook this year. Okay. What are the potential risks and headwinds? Okay, still focusing on the property sector, the housing market remains a primary drag on GDP, with a projected 0.5 percentage point to 1.5 percentage point drag as inventories remain high. As I demonstrated just now, that now the inventories amount to more than 700 million square meter. Okay, and developer balance sheets stay weak. Domestic demand, consumer confidence is low due to stagnant income growth, partly impacted by deflation and unemployment, and also falling property wealth. Rebalancing the economy toward consumption remains a top task, but a slow process. But recently, the Shanghai, the A-share fared well. The Shanghai Composite Index now has risen about 4,100 points. So at least the stock market will provide some kind of wealth effect to support consumption. But of course, the impact or the will not be as big as wealth effect from the property market. Okay, external pressures, global trade protectionism, and potential front-loading of tariffs from major partners like the US, EU, and emerging markets could crimp export growth. Okay, now the US is threatening another 25% tariff on countries with do trades with Iran. Okay, so the and then US-China, the US tariff on China is only deferred for 1 year. So coming November, when the 1 year period expires, there will be will face the uncertainty of the tariff uncertainty again. Okay, deflationary impulse, excess supply in sectors like autos and steel continues to depress prices and profit margins, requiring government anti-inflation campaigns to encourage consolidation. So the inflation data announced recently shows that CPI has improved to zero, from negative to zero in 2025 for the full year. Yet PPI is still negative, down more than around 2% for the whole year of 2025. This is impacted by excess supplies over capacity in certain sectors like autos and steel. Okay, what are the tailwinds? Would be policy support. 2026 marks the beginning of China's 15th five-year plan with expected targeted policy stimulus to support high-quality development, domestic consumption, and technological self-reliance. Interest rate environment, anticipated U.S. Federal Reserve interest rate cuts in 2026. We expect at least up to 2 interest rate cuts by the Fed this year. This will also help lower the HIBOR, Hong Kong interbank offered rate, in tandem improving Hong Kong stock market liquidity and supporting Hong Kong property market sentiment. Despite recent rallies, many Hong Kong stocks remain attractively valued compared to other major markets like the US and India, potentially attracting foreign capital inflows. Now the Hang Seng is trading on around 13 times PE, which is slightly higher than historical average. Yet during a peak period, it can trade up to 15 to 16 times PE. So we think this year there will still be upside for the index, but individual stocks may see more upside. So stock picks is essential this year, choosing the right stock to invest. Okay, but investors need to be careful of market black swan and gray rhinos. First one is which black swans means or gray rhinos means they may happen or may not happen. For black swan, sometimes it may be something that investors have never thought of. That's why it's known as black swan. But at least we have identified these potential risks that investors may need to be careful about. AI bubble burst if leading AI companies like NVIDIA underperform on high earnings expectations, combined with current high valuations and leverage, it could trigger a significant sell-off in the heavily concentrated tech sector. Okay, so if US market, if there's a sell-off in the US market, other emerging markets, Asian markets will inevitably be also affected. Okay, geopolitical events, potential for a major escalation, such as Chinese action on Taiwan or prolonged tensions from existing conflicts like the Russia-Ukraine war, is a significant concern for global markets. Lately, there are new tensions in Iran, in the Middle East, as well in Greenland. Okay, so investors have to be aware of geopolitical events, the development of geopolitical events. Federal Reserve policy error. If inflation remains persistently high in the US, the Federal Reserve might be forced to resume interest rate hikes unexpectedly. Now, I think it's not out of the radar of a lot of investors, but because if for something that's not expected, when it happens, it will become the so-called black swan. So although the probability, the chance may be not high, yet investors should take note of such potential risk. If this happens, it may disrupt current market pricing and economic recovery expectations. Another black swan is sovereign and private debt levels, high U.S. national debt, and potential vulnerabilities in the growing private credit market are concerns that could signal systemic weakness if not addressed. Okay, in the U.S., job data recent job data show job creation is slowing. For 2025, the non-farm payroll on average, monthly average, only increased by around 50,000, less than around 50,000, much lower than the 200,000 average jobs created in 2024. So slowing job growth or even negative job growth, which may be accelerated by AI trigger-related layoffs, could indicate an impending recession, which the market is currently optimistic about avoiding. Okay. Lastly, this is something we cannot beyond control. Okay, but that from time to time will happen. That are extreme natural disasters, including non-financial extreme physical world events such as new pandemics, major solar flares, or supervolcano eruptions, have the potential to invalidate all economic forecasts overnight. Okay. So our target for HSI, last year it was up 28%. This year we are more conservative. We, from a technical point of view, the Hang Seng Index moved sideways between 27,381. The peak hit in October last year, and after that it corrected to around 25,000. So it was stuck within this 2,000 odd points range for the last 3 months. It is up to end of December. So recently, today, actually has risen above 27,000. So we are expecting a final breakout of the this pattern, this sideways pattern. If it manages to break above 20,738, 381, the previous high, the next target would be the measure target would be 29,500, which from another angle, if you look at the valuation, now many investment banks, the consensus, market consensus for Hang Seng Index target this year is between 28,500 and 30,000. Okay, so I think our target, our 29,500 target is in line with market consensus, as well as from the valuation perspective, is also achievable if providing no black swans or unforeseen negative factors occur. Okay, near-term resistance will be 27,400, and the next resistance level is 28,000. Our final target this year is 29,500. So if last year it closed at around 25,600, so which implies if it manages to hit the target of 29,500, we are expecting a close to 10% gain this year for the Hang Seng Index. Key support would be 25,100. Okay. For the Hang Seng Tech Index, our target is 6,000. Sorry, it's 6,500. Okay, 6,500. But the near-term resistance will be around 6,200, and key support is expected around 5,400, where the 250-day moving average lies currently. Okay, one of the key factor that for the performance last year of a Hong Kong stock is southbound fund flows help a lot. In 2025, the net purchase amount of southbound funds in Hong Kong It means through the stock connect, money coming from mainland China, Chinese investors into the Hong Kong market, reached 14,129 billion Hong Kong dollars, setting a new historical record since the sorry, this is should be here. There's a typo error. It should be 1,412.9 billion, or 1.4129 trillion. Okay, so there's a typo error here. Sorry, apologies for that. Since the interconnection mechanism was launched in 2014, now this stock connect was already more than 10 years old. Southbound funds have cumulatively net purchase, again, there's a typo error here. It should be 5,110.7 billion, which is 5.1107 trillion Hong Kong dollars. So last year, for the last 11 years, cumulative net purchase amount to more than 5 trillion. But just 2025 alone, the net purchase from southbound funds amount to already 1.4 trillion, close to 30%, 30% of the cumulative net purchase amount. Okay. In 2025, there were over 60 trading days where southbound funds daily net purchases exceeded 10 billion Hong Kong dollars, including 11 trading days where the daily net purchases exceeded 20 billion Hong Kong dollars. And on August 5th, southbound funds net purchase 35.876 billion in Hong Kong dollars, marking the highest single day net purchase amount in history. So we reckon that the southbound funds will be an impetus to or a catalyst to the rally in Hong Kong market. It will help the Hong Kong market to rally faster, more rapidly, if we see more fund inflow from China through the stock connect. Okay, so this is one thing to monitor. Every day you can here I would also advertise a bit. If you wish to know about the daily southbound fund flow, whether it's net inflow or net outflow, you may watch my daily YouTube video. I have 3 language versions, namely Cantonese, 普通话 Mandarin, and English, which will be uploaded on YouTube. It's called Market Opening Bell, Phillip Hong Kong Market Opening Bell. Every morning around 9:30, between 9:30 and 10 a.m. So every day it will contain information about daily southbound fund flows. Okay, so recently the fund flow was not as strong as in the fourth quarter last year, because just now we mentioned that last year there were 60 trading days where southbound funds daily net purchases exceeded 10 billion Hong Kong dollars. Lately it was below 10 billion. Sometimes it was just 3 billion Hong Kong dollars. So the southbound fund flows is key to the performance of the Hong Kong market. For your information, what are the stocks that are favored by mainland investors? These are the top 10 Hong Kong stocks net bought by southbound funds in 2025. Alibaba, Meituan, China Construction Bank, Tencent Holdings, Xiaomi Group, China Mobile, SMIC, Kuaishou, CSOP, Southern Hang Seng Tech Index ETF, and CNOOC. I think these are all the big names, very familiar names. No surprise, no black horse among the top 10 Hong Kong stocks that are net bought by southbound funds most in 2025. Okay, what are the top 10 net sold? That include Sunny Optical Technology 2382, New China Life Insurance 1336, Weichai Power, Hua Hong Semiconductor, ASMPT, BYD Electronic, PetroChina, Mofista, Ganfeng Lithium, Laopu Gold. I think some of the stocks they are net sold by southbound funds, not purely because of the fundamental. Partly because they have really quite a lot in the first half. So profit taking is more because of profit taking by mainland investors like Laopu Gold and Hua Hong Semiconductor, New China Life Insurance as well. But some companies, admittedly, their fundamentals are less sound. Sunny Optical Technology impacted by the weak smartphone market, and also BYD Electronic also impacted by the handphone market, the weakening handphone market. Okay. In my last presentation, I think in October, 3 months ago, we advocate a return and growth strategy, three flavor ice cream, 三色冰淇淋, growth strategy, return strategy, and also to diversify your assets into bonds, not all eggs in one basket, all in equities. We also advocate allocation of some of your assets or your portfolio into fixed income, because this year we maintain this strategy because US, just now I mentioned, the Fed is expected to cut interest rates again by likely 2 times, and then we have this growth strategy and return strategy. Okay, for return strategy, our pick this time is Hang Seng High Dividend 30 Index. This is an ETF. The index itself, I explain a little bit about the index. The Hang Seng High Dividend 30 Index aims to reflect the performance of 30 high dividend yield securities in the Hang Seng Large Mid-Cap Investable Index. So the universe, it includes not only the large cap companies, but also include mid-cap stocks. So the investment universe is bigger. Okay, index constituent selection, there are 4 criteria. 6 months average daily turnover has to be more than 20 million to ensure liquidity and efficient tracking. And then support sustainable payouts. They will only choose those companies that pay dividend for the latest 3 consecutive fiscal years. Okay, avoid large price movements. The index will exclude top 10 of securities in terms of 1-year historical volatility. And the 4 criteria is to prevent yield traps. So it will screen out securities of which the price dropped by more than 50% over past 12 months. And also the share price, the price performance, last 12-month price performance rank in bottom 10% will be screened out. So these are the 4 selection criteria for the Hang Seng High Dividend 30 Index. So this chart shows that the index consistently outperformed the Hong Kong block market, represented by the Hang Seng Composite Index in the past 5 years. The blue bar represent Hang Seng High Dividend 30 Index performance. So it outperformed the block market, the Hang Seng Composite Index, by quite a big margin in the last 5 years. Okay, index performance still hitting new highs recently. Annualized return last 5 years 8.4% a year. Last 3 years is even higher, 24.9%, and last 1 year the annualized returns around 35%. Okay, calendar year performance except for 2020 and 2022, which recorded negative growth, and also 23. But when it's up in 224, 225, it make up for all the losses in the previous years. Okay. Index industry weighting is quite diversified. Properties and construction account for around 22%, industrials 18%, energy 14%, financials 10%, around 10%, material 8.4%, and followed by consumer discretionary, utilities, consumer staples, IT, and telecommunications. So this is the index industry weightings. Okay. So the stock code later, the ETF, the top 10 holdings are China Hongqiao, which is among the top 10 gainers among the blue chip companies last year, which I showed you earlier. Then the other holdings include Yuyuan, Hang Lung Properties, Hong Kong-based property developer and investment company, VTech, Costco Shipping Holdings, Orient Overseas International, New China Life Insurance, Hysan Development, Far East Horizon, which belong to the financial sector, and Kingport Lemonades Holding. Okay. So the ETF is Hang Seng High Dividend Index 30, High Dividend 30 Index ETF. The stock code is 3466. The fund is an index tracking fund that seeks to provide investment returns for investors that match before fees and expenses the price return performance of the Hang Seng High Dividend 30 Index as closely as practicable. Okay. Unlike Hong Kong listed stocks, which usually pay dividends quarterly or semi-annually, this ETF targets to provide monthly dividend distributions, offering more frequent income opportunities for investor. Okay, this is one of the distinctive characteristic of this ETF. How is the monthly payout yield level determined? The fund manager has adopted a prudent and conservative approach for estimating the fund's expected income. This approach considers several factors, including but not limited to stability of dividend yields in rebalance periods, backtesting results of index constituents, and impact of special dividends. To avoid excessive capital payouts from the capital and ensure long-term sustainability, a robust review trigger control mechanism will be in place to monitor and adjust income projections as needed. Okay. Okay. Now comes to the growth strategy. Just now I mentioned the difference between neutral and new neutral. Neutral in Chinese is Xin San Yang. New neutral is Xin San Yang. Okay. First of all, the Ministry of Finance stated that it will continue to implement a more active fiscal policy this year, explicitly confirming the continuation of the national subsidy for consumer goods trade-in programs. In addition, the National Development and the NDRC is promoting comprehensive rectification of inflation-style competition in industries such as new energy, vehicles, and other neutral sectors. So the so-called new trio refers to three categories of high-quality new energy products in China's foreign trade exports. They are very strong, or the amount in large amount in foreign trade exports. They have replaced the traditional old trio. Sorry, there's a spelling error here. Sorry for that. Trio. It should be TRIO. What are the old trio? The old trio include clothing, furniture, and home appliances. So many years ago, China export a lot of clothing, textiles, furniture, and home appliances. Now this is replaced by new energy products, namely EV, electric vehicles, solar batteries, as well as lithium batteries. So these are the new trio, replacing the old trio. Electric vehicles, new energy vehicles, lithium batteries, and solar cells, photovoltaic products. Okay, but the new trio, after a few years of development, now are facing the issues of overcapacity and inflation. So investors are advised to move from neutral to new neutral. Although the export data for the neutral is impressive, the domestic market has fallen into a situation of fierce price wars that you heard about among the electric vehicles, electric cars, extremely low profit margins, and severe overcapacity, prompting official authorities to launch special rectification efforts. Okay. Our view is that even some people may take the opportunity to buy the neutral upon news that there are policy support to rectify the involution problem. But our view is that it's like a person who has fallen sick, then you need to take medicine. But whether the medicine can heal the patient, it's not sure. So when you pick something to invest, will you prefer a healthy person, a healthy company, or a company or a person that has fallen sick? So neutral now has fallen sick, admittedly. Rectifying involution in the neutral faces numerous challenges. That's why I say even medicine is prescribed to the patient. Whether it will heal the sickness is not sure, is not certain. The challenges include enterprises continue to lower prices to compete for market share, leading to extreme compression of industry profit margins. By the end of 2025, although some leading manufacturers attempted joint price adjustments, the overall market remains trapped in a supply-strong, demand-weak pattern. Supply chain governance is imperfect, and small enterprises often face issues such as overdue payments, affecting the healthy development of the overall industry ecosystem. Okay. The other challenge is research institutions point out that China's production capacity in the neutral has significantly exceeded global total demand. Okay, so overinvestment leads to overcapacity. It's quite worrying that the total production capacity exceeds global total demand. Although officials are promoting market-oriented and rule of law measures to guide the exit of backward capacity, local governments and enterprises face conflicts of interest and transition pains in implementation. So the central government wants to address the overcapacity issue by forcing the exit of backward capacity. Yet on the local government level, it may cause the loss of tax and also the cause unemployment if those backward capacity are being eliminated. So there is this dichotomy between the central government and the local government. The third challenge being countries such as the US and EU have established trade barriers, plus localization policy, such as EU subsidy investigation and US high tariffs. While China tries to export its overcapacity to other countries, to take countermeasures by creating trade barriers, as well as requiring the Chinese exporters to localize, to produce their goods locally. Okay, this will increase operational costs if they set up localized production overseas. This will increase operational costs and risk. At the same time, with high dependency on exports for the neutral, now admittedly, the Sanyang, Xinzanyang, EV, lithium battery, and solar cells, they are very highly dependent on exports. So once global market demand becomes saturated, or there's a tightening in policies, policy tightening, the domestic overcapacity problem will immediately worsen. Okay, and the last challenge will be officials are attempting to normalize order through strengthened price monitoring and quality inspections. But how to maintain fair competition while not suppressing the innovative vitality, strength, suffocating innovation. Innovation is key to economic growth. So how not to avoid suppressing innovative vitality of the industry is a major challenge in policy formulation. Okay, so we favor instead, since there are so many problems the new trio is are facing, why not let's move to the new trio. Okay, what are the new trio? China's new trio refer to robots, artificial intelligence, AI, and innovative drugs. They are positioned as drivers of industrial upgrading and economic growth. These areas build on China's strengths in manufacturing, data resources, and policy support, transitioning the country from following to leading. In the past, they are following. Now, increasing in robots, also in innovative drugs, they are leading other countries. AI is catching up. Okay, AI. I think there's still the challenge because of the supply of advanced AI chips that China now is trying to replace by national production. Okay, since there is a positive outlook, this new trio will be able to attract large amount of capital. Investment is also key, essential to the future development of these new initiatives, especially with humanoid robots seen as the next intelligent terminal, while AI and innovative drugs both have mature enterprises and policy dividends. We expect more policy support towards these new trio going forward. Possessing advantages in engineering and industrialization capabilities, with some fields such as robots already entering the global first tier. Okay, policy support national policies promote industrial upgrading, providing deterministic support for innovation. By 2030, these areas could contribute significantly to GDP, outpacing global averages. For investors, opportunities abound in supply chains and startups, though geopolitical risks warrant caution. Continued fiscal incentives and innovation funding will be key to sustaining momentum. Okay. Robots, the tailwind is accelerating toward leadership in humanoids and autonomy. China is accelerating toward leadership in humanoids and autonomy. The robotics sector in China is experiencing explosive growth now, particularly in humanoid robots and autonomous vehicles, which are seen as key to future productivity and mobility. China's humanoid robot supply chain is aggressively expanding production capacity, anticipating large-scale orders in the coming years. The robotaxi market alone is forecasted to reach $47 billion by 2035, highlighting China's edge in autonomous driving technologies. Lately, they have approved L3 level of autonomous driving. Okay, so very soon we expect moving up to level 4. Okay, overall, industrial AI applications, including robotics for quality inspection, are projected to grow at a 33% compound annual growth rate through 2026. By 2030, level 3 and higher autonomous driving penetration is expected to hit 56%, driven by AI innovations. Key drivers: national policies are pushing industrial upgrades, with AI integrated robots deployed in healthcare. Example, 5G-enabled medical robots for patient care and surgery. Doctors in one hospital can control medical robots to conduct surgery remotely. Okay, China has entered the global first tier in engineering and industrialization for robotics, benefiting from vast domestic markets and supply chain efficiencies. But there are still challenges. While progress is strong, stranglehold issues in core components, especially advanced chips. This is the most important stranglehold issue or the bottleneck China is currently facing. Require increased R&D. The sector is poised for dominance in practical applications like autonomous vehicles, potentially outpacing Western competitors if policy support continues. Expect breakthroughs in humanoid robots as the next intelligent terminal, attracting billions in capital. Okay. AI, from infrastructure to ubiquitous applications everywhere. AI is foundational to China's tech ecosystem, with applications spanning healthcare, manufacturing, and beyond. The focus is shifting from basic infrastructure to AI-powered efficiency and innovation. Market and growth projections. China's AI ecosystem is standardizing rapidly, with new guidelines to enhance safety and uniformity. Investment in AI for drug development is surging globally. That's why you notice one stock which I recommend in my daily market opening bell, known as XTALPI, XTALPI. Stock code is 2228. It is AI. It provides AI drug development solution. Okay, but China's share is notable currently, with AI-driven healthcare delivery expanding quickly. Broader AI adoption in industries like pharma is expected to accelerate, with 226 seeing continued integration for optimizing trials and manufacturing. Key drivers are AI is transforming sectors like healthcare, diagnostics, and drug R&D, where China's market reached $187 million in 2024, with 30% annual growth. Policy dividends and mature enterprises are drawing massive capital, positioning China as a leader in open source AI and practical deployments. What are challenges? Challenges, despite advantages in data volume and engineering, breakthroughs in foundational sciences and standards are needed to avoid cut-neck vulnerabilities from US export controls. The 2026 outlook is strong, with AI infrastructure investments shifting toward data centers and power suppliers, potentially driving economic recovery. China could solidify its edge in AI applications for emerging markets. Okay, the third new trio is innovative drugs, which we expect to be fueled by AI, and we are expecting a biotech boom. China's biopharma sector is evolving from generics to cutting-edge innovation. In the past, China mainly focuses on generic drugs, okay, or even lower in the value chain, in the supply chain, is the intermediary and raw material for medicine. Now it's moving from raw material to generic drugs, now to innovative drugs, with AI playing a pivotal role in drug discovery and development. The AI-powered drug sector in China is set to reach 500 billion yuan, equivalent to $71.6 billion by 2030, with a CAGR of 15% or higher. Globally, AI drug development investments are expected to hit $16.49 billion by 2034, with China leading in breakthroughs like the first AI-generated drugs entering trials. The chronic and autoimmune drug market could reach $20 billion by 2030. In 2025, about 40% of drugs in-licensed by global pharma came from China. Okay, because that will save the R&D costs of a lot of the multinational pharmaceutical companies. So they in-license, they jointly join force with Chinese biotech companies to discover and develop and research new drugs, signaling a shift in innovation hubs to China, to this part of the world. Okay, regulatory reforms have streamlined approvals, boosting innovative drugs. AI is accelerating first-in-class R&D. Okay, so there are two types of medicine. Pharmaceutical companies are striving to develop. One is first in class, so you have the first mover advantage, first in class, or you are not the first, but you can be the best in class. So most pharmaceutical companies, they aim to reach either first in class or best in class or both. Okay, so including for traditional Chinese medicine, with companies like this is the one I mentioned just now, XtelPi, and in silico medicine, attracting billion-dollar deals from Western pharma giants such as Pfizer, AstraZeneca. This AI gold rush, we call it AI gold rush, is drawing global investment, enhancing efficiency in discovery and trials. Okay, what are the challenges? Of course, there will be challenges. Competition from US and EU AI startups is intensifying, and biotech hurdles like clinical failures remain. However, China's biotech is gaining an edge over the US, with focus shifting from weight loss drugs to cardiovascular treatments in 2026. With policy support, the sector is on track to dominate new drug development, potentially transforming global pharma landscape. Okay. So, all being said, what is the target of the investment target? So we picked this ETF that combines robotics and AI. Global X China Robotics and AI ETF. They have two counter. One, the trading currency is Hong Kong dollar, and the stock ticker is 2807. The other one, if you don't have Hong Kong dollar, you want to trade in US dollar, they also offer a US dollar counter, the stock ticker of which is 9807. The Global X China Robotics and AI ETF seeks to invest in companies that are positioned to benefit from the development and increase adoption of robotics and artificial intelligence in China, including companies whose principal business is in the development of hardware and software products for industrial robotics and automation, non-industrial robotics, autonomous vehicles, and artificial intelligence. The investment objective of this fund, this ETF, is to provide investment results that, before fees and expenses, closely correspond to the performance of the FactSet China Robotics and Artificial Intelligence Index. So it's a passively managed ETF tracking the performance of an index, and the index is known as FactSet China Robotics and Artificial Intelligence Index. Okay, this is the sector breakdown, sector exposure, 54.6% from IT, 26.5% industrials, 10.6% consumer discretionary, 8.1% communication services, and 99.9% all the companies are actually based in China. Okay, cash holding is only the weighting of cash holding is only 0.1%. Okay. Daily holding as of 9th January include Baidu, Beijing Kingsoft office is listed in Shanghai, iFlyTech in Shenzhen, SenseTime Group in Hong Kong. This is Shangtang, stock code 20, Hangzhou HIK Vision Digital, Shenzhen. So you can see a mix of Asia and Hong Kong companies. Okay, and then the performance, it hit a high of 67.2 Hong Kong dollar in early October last year, and then it corrected to close to $50, around I think $55. And after the correction and the consolidation now is rising again. So actually, I think we expect it to break above the previous high and seeing higher targets. So after the consolidation, I think it's also a good timing to accumulate this ETF. Okay. The performance, okay, so 1 month performance is more, it has risen more than 11%. 6 months is the gain is even more, 35%. 1 year also 35%. Okay, but it's quite admittedly it's quite volatile. So it's also good for trader if you can make use of the volatility. Sell high, buy low, you can even make more profits from that strategy. Okay, the other ETF that will benefit, that will track biotechs, because we mentioned the new trio, AI, robotics, and biotechs. Okay, so we picked this ETF, CSOP Hang Seng Biotech ETF. Stock ticker is 3174, listed in Hong Kong. The investment objective of the fund is to provide investment results that, before deduction of fees and expenses, closely correspond to the performance of Hang Seng Biotech Index. So this is also a passively managed ETF. The index is a net total return, free float, adjusted market capitalization weighted index with a 10% cap on individual stocks. The index reflects the overall performance of the 30. Maximum number of constituent stocks is 30. The 30 largest biotech companies, which are constituents of the Hang Seng Composite Index, that are eligible for trading under the Stock Connect scheme. Okay, so it will also benefit from southbound fund flow. They are classified as pharmaceuticals, biotechnology, medicine distribution, and medical devices and supplies in the Hang Seng industry classification system. The free float adjusted market capitalization of individual stocks mainly engaged in medicine distribution will be discounted by 50% in the weighting calculation. Why is that so? Because medicine distribution means wholesale and retail of medicines. Usually the profit margin is very low, especially wholesale business is concerned. So the index try to reduce the weighting of companies that they are dealing in medicine distribution. So it will be discounted by 50% in the weighting calculation. Okay. Again, its share price hit a high of close to $4.6 in early September last year, and then it had since corrected, and now I think it's also assuming the correction and the consolidation has completed. Now it is heading for a new uptrend. Okay, so it's just the beginning of another new uptrend. Performance. Okay, since scheme changes, because they have changed to another index, I think sometimes last year. Originally, the underlying index was selective biotech index. Now they changed to a new the Hang Seng Biotech Index. Okay, so year to date it was up more than 75%. So actually, year to date is from early last year to I mean in 2025 lah. So it outperformed both the Hang Seng Index and the Hang Seng Tech Index. Okay. Then it comes to this IPO strategy. IPO market has become very active lately in Hong Kong, helping Hong Kong to reclaim the top spot, number one position last year. Total funds raised amounted to 285.8 billion Hong Kong dollars, equivalent to $36.7 billion US last year, just in 1 year. Number of IPOs increased to 119 new listings from around 80 something, 80 odd in 2024. Okay, year of growth, a surge of approximately 225% in funds raised compared to 2024. Okay, global ranking, Hong Kong was the top global IPO venue by funds raised for the first time since 2019. So there's history. What are the key drivers that help Hong Kong reclaim world #1 position? First of all, last year there were quite many mega IPOs. Large-scale listings were the primary driver, with 8 deals exceeding 10 billion Hong Kong dollar. This is the fundraiser amount, and accounting for over half of the total proceeds. 4 of these were among the world's top 10 IPOs of 2025. Not only big in Hong Kong, but also big in the world. Largest listing is CATL, Contemporary Amperex Technology, the world's largest EV battery manufacturer, 宁德时代, raised 41 billion Hong Kong dollar, or 5.3 billion US dollar, through its A+H listing, making it the largest global IPO in 2025. Another driver is A+H listing. For companies that are already listed on the A share market. Now, the Chinese government also encouraged them to get a ID card, a Hong Kong ID card, to get a H listing, H share listing. Okay, last year we saw a record number of A+H listings, which refers to companies with dual listings in mainland China and Hong Kong, were completed, contributing significantly to the overall fundraising total. And because most of the A-share company, they are originally already listed on the A-share market, and usually there's a price share premium. The H-share listing price is substantially lower than the A-share price. Sometimes can be 30% or even more discount to the A-share share price. So it becomes more attractive to investors. They're buying a company which is traded on a much higher price, more expensive on the A-share market. So there's the attractiveness of A+H listings. Market reforms, the introduction of new rules such as the Technology Enterprises Channel and changes to IPO pricing mechanisms, the clawback mechanism, help attract more technology and biotech companies and boosted investor confidence. International investor interest. There was broad participation from a wide range of international institutional investors, including sovereign wealth funds and private equity funds, underscoring Hong Kong's appeal as a global financial platform. Usually, they are those anchor investors or cornerstone investors. Now, increasingly, we see not only from mainland Chinese funds or mainland Chinese institutional investors, we see more sovereign wealth funds, international foreign sovereign wealth funds, and foreign private equity firms among the cornerstone investor list. Okay, so this also give assurance to investors. Assured investors. Okay, Hong Kong's IPO market reclaiming world #1 position. Oversubscription was common for high-profile deals with record set, such as this Jinye International Group. Wow, it was 11,464 times oversubscribed. And because of oversubscription, the share price appreciation was also significant because of the supply and demand formula. Okay, overall price performance was robust with an average first day gain of about 40% across IPOs. First day up 40%. So it's quick profits, quick money for a lot of speculators. Of course, for long-term investors, these newly listed companies will also provide them options, potential investments long-term winners. Performance vary by sector and company size, with smaller tech and AI-focused IPOs often seeing the most dramatic gains due to high oversubscription and speculative interest, while larger ones show more stable but positive returns. For the larger ones, larger deals generally had solid but less volatile gains, with an average post-listing return of around 14%. Okay. The strong momentum and a record number of active IPO applications in the pipeline. It was reported that the Hong Kong Hong Kong Stock Exchange, had already received more than 300 IPO applications that is now processing in the pipeline at the end of 2025, suggested a robust start of 2026 this year. So there are more than 300 active applicants in the pipeline as of late 2025 and early 2026, a significant increase from previous periods. Previously, usually 200 is considered good. 200 applicants, IPO applicants that apply for listing to the Hong Kong EX is considered a good number. Now, at the end of 2025, the number increased to 300, more than 300. So we are not worried about lack of IPO candidates in the next 2 years, at least this year and next year, because every year companies are around 100 to 120 companies are expected to get listed every year. So these 300, more than 300 pipeline can be sufficient for 3 years IPO listing. Okay, a large portion of the pipeline consists of new economy companies, particularly those in the IT, retail, consumer, and biotech sectors, many of which apply through the new Chapter 18A and 18C listing rules, or the Technology Enterprises Channel, TEC, abbreviated TEC, TECH. So these are companies with good prospects. If you get a lot of IPO applicants from property companies, textile, the old trio, it won't be attractive enough. But now a large portion of the pipeline consists of new economy companies. And a substantial number of H-share companies and A+H dual listing candidates from mainland China are seeking to list in Hong Kong, with one estimate indicating around 14 large mainland firms with market caps over 300 billion yuan are potential candidates for future IPO activity. Of course, the Hong Kong EX aims to diversify and not to rely heavily on China. So overseas interest, the pipeline includes companies from diverse international regions such as the United Arab Emirates, Singapore, and Thailand, reflecting Hong Kong EX efforts to expand its global reach. Okay, one way to invest, to participate in the IPO market is to apply for the IPO. This one, if you are interested, you may contact your dealers or remisier with PSPL, PhillipCapital Singapore, to ask about the requirement. I think there are some requirements, such as only for AI accredited investors, and what is the whether there will be margin financing to apply for a bigger amount, so as you can get a bigger allotment. So the game played in Hong Kong IPO application is why the oversubscription is so massive, over more than 10,000 times oversubscribed, is all the people are expanding their application amount by using margin, amplifying the application amount. So normally in Hong Kong, investors can apply for 90% margin financing. That's in Hong Kong. I'm not sure in Singapore the requirement. So investors can apply for 9 times leverage the amount, IPO amount. Okay. But if it's so difficult to apply for IPO, or the allotment is not is very small. So we also suggest investors taking a look of our ETF. This is an ETF managed by PCM Hong Kong. It's known as Phillip Hong Kong Newly Listed Equities ETF. Stock ticker is 2835. That's the first one, and also the up to now the only one ETF that tracks newly IPO companies, newly listed companies. Okay, so it's screened for high quality newly listed stocks. The index constituent screen process imposes strict requirements on the free float of shares, effectively preventing the inclusion of stocks with overly concentrated equity ownership. Purchase a basket of multiple new stocks at a lower price. The minimum lot size is 100 shares. Now it's trading at around 13, slightly above 13 Hong Kong dollars. So it was listed, the listing price was $10. So now it was up more than 30% from the listing price. The investment amount, one bought lot, 100 shares, is only 1,300 Hong Kong dollars. Okay, and with this investment amount, you can invest in around 50 IPOs, newly listed companies in Hong Kong, for a minimum of around 1,329 Hong Kong dollars as of November 10th, 2025. It will help also mitigate losses due to misjudging the market or individual stocks, because the minimum number of constituents is 35, maximum is 50. So which means good diversification. Some of the newly listed stocks exhibit significant volatility. There's also the risk, volatility risk investors must be aware of when they deal with Hong Kong newly listed companies in Hong Kong. And certain sectors like pharmaceuticals and biotechnology require specialized knowledge to fully grasp their business operations. Investing in this ETF can effectively diversify the risk associated with individual stocks. The fund, the ETF, aims to fully replicate the selective, customized Hong Kong newly listed equities index. So this is also a passively managed ETF, which is designed, the index is designed to track the performance of securities recently listed through initial public offerings, IPOs, or newly listed on the main board of the Hong Kong Stock Exchange based on certain conditions, such as by introduction sometimes, or spin-off from a parent company. The index will be rebalanced quarterly, including securities that conducted IPOs or were newly listed within the past 756 trading days. 756 trading days is more or less equivalent to 3 years. That means the candidates, the constituent stocks, are companies that are listed in the last 3 years. Once it has exceed more than 3 years, they will be removed from the index. So the index will always consist of newly listed companies. Okay, and it will select the top 50 securities by free float market capitalization. Additionally, subject to liquidity and market capitalization standards, the index will include eligible newly listed securities after a monthly review. Let me explain a little bit, because the rebalancing is done quarterly. But every month there will be new IPO listing, new debuts. So this ETF will include, will add newly listed companies every month. We call it fast track. Like when you take the flight, you can take the fast track to save time, the save queuing time. So this ETF, the index design, accommodate companies that are listed every month. It will be included into the index and the ETF. So top 10 holdings now include Horizon Robotics, which belongs to the robotic area. J&T Global Express, this is logistics. I think it originates in Indonesia. also has business in Singapore and Malaysia. I'm not sure whether you are familiar with this company called J&T Global Express. CATL, okay, lithium battery, the biggest, largest lithium battery player. Media Group, Meidi, besides home appliance, is also now transforming to the manufacturing of robots. So also robotic investment scheme. Pony AI, Pony AI 小马自行, this is dealing with autonomous driving, AD, okay? Exterpie Holdings, which I have mentioned a few times just now. This is advanced medical drug discovery platform, drug discovery solution using AI. So this is AI and biotech theme, combined AI and biotech theme. UBTech robotics, also the robotics theme. Hesai Group is also listed in the US. Now it's duly listed in the US and Hong Kong. This is autonomous. It is manufactures LiDAR, the key component for autonomous driving. Okay, Laopu Go consumption and Wuxi HDC 无系那个药明生物Wuxi HDC also playing on the biotech biopharmaceutical theme. So these are the top 10 holdings, okay, for your idea. Okay, the sector breakdown is also quite diversified. 26.5% in IT, industrials accounting for 28%, and then followed by the green one is consumer discretionary, 20.3%, 16.3% is healthcare, okay, and then 4.4% consumer staples. Financials only account for 2.4%, but because in the last 3 years, fewer and fewer financial companies are getting listed. So this ETF, one distinctive feature, unlike the other thematic ETF, the other thematic ETF, the themes are quite static. Either is, say for instance, new energy. It will always be new energy. Or robotics, it will always be robotics. But our newly listed equities ETF, the theme can change over time with the different mix of newly listed companies. Now, of course, robotics, AI companies are hotly sought after, and we are envisaging more listing of such companies. But imagine 3 years later, when we may see a new trio, 新三样, and then when they get listed, they will be included into the ETF. So the investment theme is actually not static. It is very dynamic kind of investment themes that follow the IPO market. Okay. Okay. This is the performance. It went up last year. It was at the highest. It was up more than 60%, from $7, more than 100%. Actually, if investors manage to bottom fish, bargain hunting at the trough around 7 Hong Kong dollars, and then it rallied to $15, and now it saw a correction to $12, a very healthy correction, up $8, down only $3, about 30% or 40% of the gains, and now it looks to be heading for a new uptrend. Okay, so it's also I think 2026 is a good timing for investors to invest in the Hong Kong market, because the Hong Kong market, let's go back, has sorry, the Hong Kong market has already undergone consolidation and correction phase for 3 months. So now you are not getting in at the peak, at the highest level, and the market has already corrected and consolidated for 3 months after hitting the peak in October last year. So last but not least, I would like to draw your attention to my daily videos, Market Opening Bell, to get the first-hand information about Hong Kong market information every day. Okay, so there are three versions: English, 普通话, and Cantonese. Okay, so this is you can search it on YouTube. Is an in-depth analysis of the Hang Seng Index, global market hotspots, and selected stock strategies. We'll every day we'll come up with a daily stock pick. Okay, so that ends my presentation today, and let's see what questions the viewers have for me. Okay, am I expected to orchestrate the question, or you the host will ask the question, will pick the question and ask me?
Hi, Louis. You may pick your own question in the Q&A section or the chat box.
Okay. So shall I focus more on the Q&A or the chat box? Because I
You
saw
may
there are
prioritize the Q&A.
Q&A first, okay? There's echo in your voice. Sorry. I hope this has improved over time. Do you see pharma and biotech stocks to do well? Yes. And what will be your growth projection and comment of current valuation if you think so? Valuation is not cheap, honestly speaking. And some biotech company, biopharmaceutical company, actually some of them don't even have revenue yet, because some of their pipeline products are still under clinical trials, clinical testing. But I think for individual company, better pick those one that have lined up with multinational drug companies such as Pfizer, AstraZeneca, and they are poised to receive milestone payment from those companies. So that's a safer bet. And also companies that are already in with drugs, with pharmaceutical products that are entering the third clinical phase. First, if they are still in the first clinical phase, the risk of failure, the failure risk is rather high. So to avoid, if I think admittedly it's difficult. It's not easy to pick biotech stocks, biopharmaceutical stocks, because it's very technical, and also we are not biotech specialists. So one thing, that's why I come up with this ETF. You may use biotech ETF to serve, the purpose to diversify risk, and also to reap the benefits of the future growth. Okay, please give some comment on the latest IPO Shanghai 9903. Let's see, 9903. Because I have not prepared this one, maybe later I'll come back to this question. Let me see. This is newly listed. Data. Sorry, give me a few seconds. Elevator 9903. The stock is listed lately. Let me see, 9903. Sorry for so try to pull out the chart. Okay, 9903. Oh, yeah, this is uh lately there are 4 GPU companies lately listed, 2 on the Asia market and 2 in Hong Kong. So this one has the GPU China domestic GPU concept. I think long-term outlook we are upbeat about this company because it's specializing in the development of general purpose graphics processing units, so-called GPU, and AI computing solutions. Okay, it was listed on the 8th January this year. It raised 3.68 billion Hong Kong dollars through its IPO, and then it saw strong initial performance, surging over 30% on the first day. So now I think you may wait for consolidation. I think close to $150 would be a better entry price level. 150. Now it's trading at 160 today. It closed in the morning session at 173.1. So you may wish to wait for the price to correct to $150. Okay. Next one. There are any Hong Kong or China companies listed on the Hong Kong EX that are major players in the China space program? There is one. Let me see. Okay. There is one I have to recall. Give me a few seconds. Okay. And then any comment on energy, electrical capacity, green and alternative nuclear growth, power growth in China and the stocks prospect. Okay. Short term, we have reservation for power companies. But long term, we are positive because it's well known that AI will consume a lot of electricity, which will benefit power companies in the long run. But in the short run, before the popularization of AI and also AI data center, the power consumption in China is still impacted by the overall economy. When the economy weakens, you can see that the power generation as well as consumption in last year was quite dismal. And we don't think it will pick up a lot at least in the first half of this year. Only when we see the popularization of AI and AI data center, which drives the demand for electricity, will see the benefits on those companies. Okay. Oh yeah, one company is 1725, Hong Kong Aerospace Technology Group. 1725. It's Hong Kong's first commercial aerospace enterprise, specializing in satellite constellation engineering, manufacturing. Another company dealing with satellite is APT Satellite, stock ticker 1045. The first one is Hong Kong Aerospace Technology 1725. The other one, APT Satellite Holdings 1045. And also Asia Satellite Telecommunications 1135. Okay. And there's also one company, I read the news lately, that deals with wind power, manufacturing of wind power generation equipment. The company is known as Xinjiang Goldwind Science and Technology, 金风科技, stock code 2208. It does not directly, it is not directly involved with space technology, yet it is holding a 8.3% stake in a company called Land Space Technology, which is a private Chinese rocket firm, okay, that has launched methane fueled rockets and is advancing IPO plan. So 2208 as the is a concept concept stock, this space concept, 金风科技. Which will have the highest upside for 226 China A share or H shares, Hong Kong Tech or Hang Seng? Okay. China A share, I think the one thing to take note is the regulator, Chinese regulator, may not want to see it rally too rapidly. So to avoid a bull run too fast. So they always prefer and emphasize slow bull, 慢牛. So in the light of that, I think H shares will perform better than A share or the Hong Kong Tech Hang Seng. Among the three, I think Hong Kong Tech, just now I show you the chart, it's underperformed the Hang Seng last year. So there's high chance if there are more catalysts, because the new trio, robotics, AI, and biopharmaceuticals, they are all categorized as tech companies. Okay, so if this new trio take off, I think Hong Kong Tech Index, the Hang Seng Tech Index, will outperform Hang Seng this year. Last year it underperformed because it was only up 23%, around 23%, whereas the Hang Seng was up 28%. So this year, I think it's more likely that the Hang Seng Tech Index will outperform the Hang Seng, provided that there are more catalysts, positive catalysts for the index. Why high fluctuation in new IPOs like Biotech Technology? Because Biotech, first day, let me see how much it rallied. Biotech, for companies that really, I mean the price appreciation, Biotech, okay. We'll see profit taking, at least on the first day. Biotech 科技. It was up 82.1% on the first day, on its debut. So I'm not surprised to see some profit taking to cause the profit taking by some investors that results in the volatility in the share price. Is Link REIT still a Hong Kong REIT to consider? Yes. And I'm still upbeat because in the, I think half year ago, I recommend Hong Kong Link REITs. Besides its resilience in the current economic climate. Also, I think one catalyst, one potential positive will be the Risk Connect, which is still not yet materialized. But I think it's very likely that this REIT Connect has been talked for a few years already, because it involves taxation issues in China. So that's why up till now they have not launched the REITs Connect yet. But I think it's only a matter of time that the REITs Connect will be launched, and with Link REIT being the largest REIT in Hong Kong, I think once it's included in the Risk Connect, we'll see southbound fund flows into Link REIT, and also the yield is quite attractive. China Mobile seems to be on downtrend lately. Is fundamentals still sound? Yes. We don't realize or notice any fundamental change in its fundamental business, except that investors may be concerned about future capital expenditure in 6G because now 5G is maturing. I think people start talking about 6G. So 6G will involve huge capex, capital expenditure, which may affect the dividend payout. But I think this will take time. 6G will not come instantly. And also, even if they have to invest in for 6G, it will be in like 5G. What they did for 5G, it will be incremental investment. Spend over 3 to 5 years to build network and capex into 5G. I think the recent weakness is more because of southbound fund selling. Okay, up to yesterday, southbound funds have net sold China Mobile. How many days? Let me see my data here. They have net sold China Mobile for 7 consecutive days, totaling 5.283 billion Hong Kong dollar up to yesterday. Okay, so I think that it's a short-term weakness due to selling pressure from southbound funds. So you may observe whether this selling pressure will ease in the near term. Then I think China Mobile is okay. I don't see any fundamental change. Okay. Between US versus China market, which is forecasted to have higher upside in 226. Still, I think China. Because Hong Kong, Hang Seng, we are projecting close to 10%. Any luck, it will be more than 10%, will be double digit. But I think for Dow and S&P, market consensus is single digit growth this year. Okay, so in terms of upside, I think Hong Kong will bring more upside than the US market. How about US technology versus Hong Kong technology sector? Well, of course, US technology, you have a lot of to choose from. The Max 7, but I think now some laggards are catching up. We like Intel, we like Alphabet. Okay, these are the two laggards that may catch up this year. Alphabet is actually caught up already. Now the focus will be on Intel and also AMD. Okay, Hong Kong technology in terms of the technology level, of course, Hong Kong lags far behind. There's no NVIDIA similar in Hong Kong, not even TSMC, China this SMIC is considered 1.5 or 2 generation behind TSMC. But some of the Hong Kong tech companies, the valuation is cheaper compared to US tech companies. So try to pick those with good growth potentials, yet cheap or attractive valuation. Okay, could you please share your views on Fortune REIT, CK Infrastructure, and Beijing Jingnan Clean Energy? Their share price outperformed the market. I think quite very resilient, except for Fortune REIT, because the retail market in Hong Kong is still weak. A lot of closure of retail business closure. So the vacancy rate is going up. So Fortune REIT, if you want to choose a REIT, of course, Fortune REIT, the yield is higher compared to Link REIT, but this may be a yield trap. Its yield higher is because the price of the REIT falls much more than other REITs, so it gives you a higher yield. This is known as yield trap. It's not the real, genuine high yield. It's more because a factor of the drop in the price. So be careful of that. CK Infrastructure, I think, is well diversified. Most of its assets are in UK, Europe, that provide stable investment return. Okay. Recently, there's also one CK Hutchison has announced a plan to spin off Watsons to be duly listed in Hong Kong and London. So among the CK group of companies, I think CK Hutchison, stock ticker 1, 0001, may outperform other members of the CK group companies with this spin-off concept. Beijing Jinnan Clean Energy, stable and steady. I will describe stable and steady. Okay. Do you see improved business outlook for Chinese EV now that EU or China are working out a minimal selling price? Yes, but once they raise the price, whether it remains to be seen whether the competitiveness, because China EV dominate in the EU markets is because of the price competitiveness. Going forward, if they are forced to raise the selling price, if to set a minimal selling price, it depends on the minimum selling price to be set. I mean, how much higher than the current selling price, whether that will undermine their price competitiveness. So I can't tell. The landscape is quite fluid at the moment. But according to this, in my market opening bell, I also addressed this issue by quoting the comments from an insider, market industry. Yeah, that's the China Passenger Car Association, CPCA, the Secretary General, Cui Dongshu. He believes that in early 2026, new energy passenger vehicles will be affected by adjustments to vehicle purchase tax policies. Another factor to watch out is the adjustment in vehicle purchase tax policies. They will reduce. So he expecting sales in the first half in early 2026 to decline at least 30%. So in the near term, EV stocks still need to be careful because market participants are expecting sales to decline at least 30% quarter on quarter seasonally. And regarding the EU's release of the guidance document on submitting price undertaking applications, Cui Dongshu said that in the initial stage of implementing the price undertaking mechanism, some car companies may experience short-term sales fluctuations due to adjustments in product pricing and structure. So there may be even to sales fluctuation, short-term sales fluctuations expected. However, as car companies adapt to the new rules, it takes time. It takes time. It will take time for car companies to adapt to the new rules and also to localize production capacity, set up production bases in overseas, and enhance product competitiveness. He believes that sales of Chinese electric vehicles in the EU market will gradually recover. So it takes time. He expects that from 2026 to 2028, China's electric vehicle exports to the EU will maintain an average annual growth rate of about 20%, becoming an important engine for growth in the global electric vehicle market. So it's as a view from an industry expert. Okay. This is the worst day of Alibaba over? Could you please share with us your latest price target? Alibaba lags behind recently. I think it's more because of investors' concern about its investment in the instant business. Okay. Yesterday in my daily market opening bell video yesterday, I highlighted that Alibaba will increase investment to strive for market share with expected losses for its on-demand retail business, reaching is forecasted that in financial year 2026, its on-demand retail business will incur losses of 90 billion yuan. That will eat into, of course, it has solid profits generated from its e-commerce business. Yet, because of the need to nurture new business, the on-demand retail business, it has to burn money. So this financial year, this year, is expected that it will incur a loss of 90 billion yuan, and next year still will post losses of 60 billion yuan. And due to intense competition, market concerns over Alibaba's cash burn are gradually rising. That may explain for its underperformance recently. So upside, let me look at the chart. Yeah, Alibaba. Technically speaking, is broken above, finally broken above the 50-day moving average at $153. So the near-term target will be 175, and medium-term target will be 190. Okay, 175, 190. Any views on New World Development? Oh, they are still struggling with their debt refinancing. Okay, my view is although it looks cheap lah, yet I mean the risk and return, you have to evaluate the risk, whether being an ongoing concern, whether it's able to be an ongoing concern. Okay, what's the current dividend yield like for 3466 ETF? 3466 is let me check. 3466 is it's around 7%, 7% yield, 7.5%. Not bad, huh? I have Ping An Insurance 2318. Are you able to comment on this stock as it's moved up quite a lot in the past few months? We're still optimistic about its upside, because if the China age the bull market continues, insurance companies will benefit, expected to see a higher investment return. Okay, and also recently we saw Chinese moving their deposits from banks to insurance products to earn a higher, because deposit rates remain relatively low, and there's also a high chance that the People Banks of China will cut rates further this year. So we notice depositors are moving their deposits into insurance products. Of course, some may invest in the increase their investment in the stock market, and with stock market continuing rising, Ping An will also, and other insurance companies will also benefit as they expect to see better investment return. But if you are sitting on a floating profit, our advice is to, no matter how bullish, how upbeat you are about a certain sector or company, set a stop profit, set a stop profit to lock in the profit in case there's any sudden or unforeseen change in the price trend. Okay, what will happen to the newly listed ETF when the IPO dry out in the future? Yes, it will be then the index has already made for such a provision. If there's a dry out in the Hong Kong IPO market, it will re-include those companies that are listed in the last 4 years. That's the plan B, the contingency plan already taken into consideration when Selective design, customize the index, this IPO index with us, with Phillip Capital Management. So it will, to make sure there are enough constituent stocks, they will get back those companies that are listed in the last 4 years. Okay, but as I mentioned just now, with more than 300 companies applications in the pipeline, I think there's no imminent worry. At least investors do not need to worry about IPO drying out in the next at least 2 or 3 years. Okay. Does Phillip always get allocation to the new IPOs? The ETF now invest in companies after its listing, so it's secondary listing. Only will invest after the IPO is listed. But we are revamping the index. We are discussing with we'll announce that once it's revamped to allow the ETF to apply for IPO. That means to invest in the primary market before the listing. So it will be but I mean, because we have not started doing that, so I can't provide you data whether we always get allocation. Okay, but it will stand a good chance because 2835 is the first and only IPO ETF listed in Hong Kong. So as a fund, I think we'll stand a good chance to get better allotment in the share placement of new IPO going forward. Okay, 3 more minutes. Okay, may I know, is CATL still worth to buy? What is the entry price for? No, as I mentioned just now, I personally is rather downbeat on the new trio, not the new trio. So new trio includes the lithium battery, which is suffering from overcapacity. Will it be affected by EV car market slowing down? Definitely. But one saving grace or one silver lining depends. We have to see how big the market growth is. Power storage system, because power storage also has to will create demand for lithium battery. Lithium battery are both used for electric cars as well as power storage. Okay, so at least there's some silver lining. Okay, where do you see the EV auto market heading to? Overcapacity? Are they going to be trashed due to all the price wars? Who will be the winners in this sector? I think the big ones always is the big one that eat up the small ones. So we expect more M&A going forward, or failures among the smaller. So be careful, especially if those smaller competitors, smaller companies, they may be phased out, or they may be trashed out. So this is one risk investors need to be beware of. Is there a chance Hong Kong dollar will depeg from US dollar? Especially in the recent economic environment. I think unless it's something from the US, otherwise Hong Kong government and China will not, it's my personal view, will not, I mean, it's not in the, at this economic environment, it's not advisable to depeg or repeg US dollar. Yeah, so I think people have been talking about this, wow, since 1997, since the Asian crisis. Now it's already 30 years. If they don't depeg the Hong Kong dollar when the Hong Kong economy is strong, you only depeg, I mean, consider depegging when Hong Kong economy is strong, so they can withhold the selling pressure. The peg, I think, serves for Hong Kong dollar resilience. So the peg at this kind of environment will only may bring about depreciation in the Hong Kong dollar, which I don't think Hong Kong and China wishes to see. So, but never say never. I don't know lah. If I ask you answer your question, is there a chance? There may be a chance, but when this will occur, it's hard to say. And I think what I can say is in the near term, no, I don't think there's a chance in the near term that 1-2 years horizon will see a depeg, Hong Kong dollar depeg. Okay. So regretfully, I cannot answer all the questions. So now we are reaching 2 p.m. So thank you for your time, and I'm looking forward to my next presentation. I think probably in 3 months' time. And I wish all of you a prosperous Chinese New Year, the year of the horse in advance. 恭喜发财，财源广进。身体健康，谢谢大家。
Thank you so much, Louis. For those that we did not manage to answer your questions, I believe that we can all visit Louis's YouTube account every day, so you can see daily updates. So before you leave the webinar, there is a feedback form for you to fill in order to receive a promo code in your inbox. So you may now scan the QR code on the second QR code at the bottom, so that we will be sure to fill in your info accurately so we can share you your stock coupon promo code. You'll receive it within 5 working days after the event ends on 16 January 2026.
Can I add one point?
Of course.
Yeah, because I saw one question asking, can I share with my individual top stock picks within the China new trios, the NNT segment? I think you can refer to because I deliberately show you the top 10 holdings. You can shortlist. It's already shortlisted. You can if you don't like the ETF, you want to, or you besides investing in the ETF, you want to also pick individual stocks to invest in. I think you can consider from the top 10, from the top 10. And in my daily YouTube video, YT video, my daily topic will focus more on the NNT because these are companies with better prospects. So you will see that my daily stock pick will also give you idea of what kind of NNT stocks are worth investing in. YouTube account is Phillip Hong Kong. The YouTube channel is Phillip Hong Kong. Yeah, not my personal YouTube account. Okay, thank you.
Thanks, Louis. At last, everyone can scan to redeem a 50 coupon from our sponsorship SocGen. You may now scan the QR code from your Phone's Mobile 3 app. If you haven't have this app downloaded, you can have it now to scan and redeem the SocGen coupon. So thank you so much for joining today, and we hope to see you again. Take care and have a nice day.